Hello everyone. Today, in this video, we are going to have a discussion on the topic Disclosure of Non-Current Investments in the Books of Accounts from the chapter Financial Statements of Companies. Before going into our today's topic, let's do a quick recap on what are financial statements. According to John and Meyer, the financial statements are a summary of accounts of a business enterprise, the balance sheet showing the assets, liabilities, and capital as on a certain date, and income statement showing the results, that is, profit or loss for the period. Now, according to him, financial statements are a summary of business transactions and depict the various financial transactions and account balances through the statement of profit and loss and balance sheet, respectively. These are summarized statements of accounting data which gives information as to profitability and financial position of a company. Now, as we have learned earlier from our previous classes, that balance sheet shows the financial position of the company, yes, and the statement of profit and loss shows the profitability position of the company. Financial statements are the final product of the accounting process prepared following the accounting principles, practices, and the accounting standards. Financial statements are the final product of the accounting process. Now, as we know, the accounting process consists of journalizing, that is, recording the financial transactions in the journal, and then preparation of the subsidiary books, and then posting that information into the ledgers, and then the preparation of the trial balance, and only on the basis of the trial balance we can prepare the balance sheet and the statement of profit and loss. Okay, and how are these prepared? How the financial statements are prepared? We cannot prepare financial statements just as vaguely or as we like, right? And for that, and for the preparation of financial statements, there are certain accounting principles and practices and accounting standards which are to be followed while the preparation of financial statements. Section 129 of the Companies Act 2013 prescribes that the balance sheet and the profit and loss account, that is, statement of profit and loss, are prepared in the form prescribed in the Schedule 3 of the Companies Act. Now, what does the Act say? The Section 129 of the Companies Act insists the companies that they have to prepare the financial statements, that is, the balance sheet and the statement of profit and loss, in the form that is prescribed in the Schedule 3 of the Companies Act of 2013. Now, I'm sure that you all must have seen that form in our textbooks and the previous video, so I'm not going to show them again in this video. Non-current investments. Now getting into our topic. Non-current investments are investments which are held not with the purpose to resell but to retain them. Why do we make such non-current investments, or why do we make such long-term investments? Another name of non-current investments is long-term investment. Why do we retain them? This is done in order to gradually build wealth over an extent of time by buying or holding some investments, some investment instruments like shares, land, gold, silver, etc. That is, we are buying such investment instruments in order to gradually build wealth over a time. Okay. Non-current investments are further classified into trade investments and other investments. Non-current investments are further classified into trade investments or other investments. Other investments are also known as non-trade investments. Trade investments are investments made by a company in shares or debentures of another company to promote its own trade and business. For this, I'll use an example. Suppose we know some DTH companies like Tata Sky, Sun Direct, Dish TV, etc. Okay. Suppose Sun Direct DTH is investing in the shares of Tata Sky or Dish TV. Now, since all these three companies are in the same strain or in the same market of DTH, we can say that Sun Direct DTH is making such an investment in order to promote its own business, right? Here, it is trying to promote its own business by investing in the shares of other competitors. right? Now, other investments are, as I said, non-trade investments are those investments which are not trade investments, right? So we'll use again this example. If Sun Direct DTH is investing in some other companies such as TCS, Tata Communication Services, or Indian Oil Corporation, there the markets are completely different. The businesses are completely different. So why they are making such an investment? There they are trying to build their own wealth by investing in other companies. Okay. Investments are classified or shown under the following heads. Now, the various non-current investments that the business does, they are classified or grouped under certain heads. Okay. Investment in property. When a business invests or purchases a part of land or a building, or not necessarily a tangible one, it can also invest in certain patents or trademarks or copyright. Then that investment comes under this head. Investment in equity instruments. Now, equity instruments is just another name of equity shares. So when a business invests in the equity shares of another company, then that comes under this head. Investment in preference shares. Investment in preference shares is, like the name suggests, when a business invests in its money in the preference shares of another company, then that comes under this head. Investment in government or trust securities. Now, what does this mean? Every government has a treasury, right? So when there is a situation of inflation or deflation, the government sells out or purchases some of its shares. Okay. So if a business invests in such securities, and these securities are also known as bonds. So if a company invests in these bonds, then that comes under this head: investment in government or trust securities. Investment in debentures or bonds. As we know, companies can also issue debentures. So if a company invests its money in the debentures of another company, then that comes under this head. Investment in mutual funds. Mutual funds, we all know, right? Through the advertisements that come in the TVs or newspapers. So if a company invests its money in the mutual funds, then that comes under this head. Companies can also invest in not only another companies, but it can also invest its money in partnership firms. So if an investment is done in such partnership firms, then that comes under this head. Other non-current investments. So as we have mentioned right now over here, we have mentioned 7 heads, and if the company or if the business invests in some other investments or other non-current investment instruments, then those come under this particular head, that is other non-current investments. Disclosure in the books. A company shall disclose the following in the notes to accounts. So the Company Act requires the companies to provide a bit more of information regarding the non-current investments that they have made in the books, in the notes to accounts, in order to make the financial statements a bit more reliable and accurate. Okay, so what are those? Under each classification, that is under each non-current investment, details shall be given of the body corporate in whom investment have been made. That is, under each non-current investment, the details regarding the body corporate or the other entity or the other business in which the present business has made an investment has to be given, and it also has to be specified separately whether that entity is a subsidiary or an associate or a joint venture or a controlled special purpose entity. Okay, and the nature and extent of the investment so made in each such body corporate. That is, the nature of the investment has to be explained, and the extent of investment, how much investment we have made in the other body corporate, is also to be mentioned. Okay, showing separately investments which are partly paid. suppose we have agreed to pay a sum of around 1 lakh rupees, but we have only made a part payment, that is we have only paid around 50,000 rupees. So that information also has to be provided separately. Investments carried at other than cost should also be separately stated, specifying the basis of valuation thereof. That is, sometimes companies do make investments not on the basis of the market price, but on the basis of some other uh, valuation, that depends on company to company. So that information also has to be specified over here. Next comes, following should also be disclosed. And what are those? Aggregate amount of quoted investment and market, aggregate amount of unquoted investment, and aggregate provision for diminution in the value of investments. So what are first, before going into this, we have to know what a quoted investment or an unquoted investment is. So a quoted investment is an investment in securities which are listed in a recognized stock exchange. Okay, so while making a investment, we all if that investment is listed in a recognized stock exchange, such as the Bombay Stock Exchange or the New York Stock Exchange or many more, okay, then that investment or that security or that share is known as a quoted investment. Okay, and if the investment is not listed in any of the recognized stock exchanges, then that is known as unquoted investment. Okay, so the first point says aggregate amount of the quoted investment and market. So the company has to disclose the aggregate amount, that is the total amount of quoted investment, how much we have invested in a quoted investment, and we also have to disclose the market in which this quoted investment is listed. Okay, aggregate amount of unquoted investments, how much the company has invested in an unquoted investment or in unquoted share. Okay, so that amount also has to be specified. Aggregate provision for diminution in value of investment. Sometimes it so happens that the value of investments, the market value of the investments get reduced due to fluctuations in the market. So we have learned the principle of prudence, right? We have to provide for the future losses and not provide for future profits at all. So foreseeing such a future, how much provision the company has provided, that must also be disclosed in the notes to accounts. Okay, so I think that's it to my part of presentation. Thank you so much.